Well, hello there. So in this video, we're going to do module 67, which is all about monopolistic competition. And it's important that you kind of hear what I said there. It's not monopoly, right? So students over the years are like, monopoly, okay, it must be monopoly. No, 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 no. This is the fourth market structure, monopolistic competition. So let's go ahead and do the check your understanding. So this assumes that you've watched those videos and you know what a graph looks like of this particular thing, or else this is going to be a little bit tricky. So let's do number one. Suppose a monopolistic competition industry composed of firms with U-shaped ATC curves. Okay, so that's what they normally look like, is in long-run equilibrium. So that means they're all earning normal profit. For each of the following changes, explain how the industry is affected in the short run and then how it adjusts to a new long-run equilibrium. So how does it move around? That's kind of where we're going there. So a technological change that increases the fixed cost for every firm in the industry. So if the fixed cost goes up, we can think about like what's that going to do in terms of all the different curves that are on actually the graph. And in fact, just to kind of bear with me for a second, I think it's valuable if we have a graph that we can just kind of refer to as we do these. So you know, you can draw this or not. It's kind of up to you, but I think it would be easier if we think about it this way. So we know that they're in equilibrium. And so that means they're producing at MR equals MC and all that good stuff, right? And we know that they have this kind of down tangent, minimum, back up again, ATC. So they said the fixed cost goes up. So out of all the things that are on here, the one that's the fixed cost is the ATC curve, because the marginal cost doesn't include necessarily that fixed cost on a per unit basis. It's telling, marginal cost tells us like what's the additional cost of an additional unit. So it really just reflects the changes in the variable cost. So the ATC is going to tell us the fixed cost. And if the fixed cost goes up, the ATC will go up, right? And so we can kind of visualize, I'm not going to draw it on here, but visualize what would happen. That ATC curve goes up, well, the companies are now losing money. So we'd say firms experience losses in the short run, right? So firms start to lose money. And then in the long run, firms will exit the market. And so for an individual firm that does survive this kind of culling or thinning of the herd, right, kind of a term there, it would make the demand curve for each individual surviving firm go up, because the amount of demand for the product stays the same, right, in the big picture. But from each individual company's perspective, well, they get a bigger piece of the pie. So we'd say, so remaining firms see their demand increase, and they get normal until they get normal profit, right? And so that demand curve would move out to the right until it touches that new ATC again, and they all experience normal profit. So B says a technological change that decreases marginal cost for every firm in the industry. So now this one would be the MC curve shifting downward and the ATC curve actually shifting downward, because ATC incorporates both the fixed cost and the variable. It's average total cost, right? So if the marginal cost of producing a unit goes down, then we'd say both of the cost curves shift down. So if MC shifts down and ATC shifts down, well, then we can say that you know, in the short run, firms would be earning a profit because their costs are lower. So therefore, firms earn, we'd say, economic profit. Then in the long run, and so that first part is in the short run, right? And then in the long run, new firms enter the market. And so as new firms enter, what's going to happen to the demand for the existing firm's products? Well, there's more competition, right? And so it's going to drive the demand for an individual firm's products down. It's going to decrease their slice of the pie, because, right, more firms now, and there's the same amount of overall demand, so an individual firm would see less demand for its product. So the demand decreases for an individual firm, and firms until they earn normal profit, right? And so eventually it will kind of shift back to that long run equilibrium. Okay, Let's take a look at number 2. It says, why is it impossible for firms in a monopolistically competitive industry to join together to form a monopoly that's capable of maintaining positive profit in the long run? And initially you could say, well, it'd be impossible because there's too many firms, but that's not actually the problem. That is a problem to forming the monopoly. But assume that they could, we would say that in the long run, well, what can happen? If there's positive economic profit, we just saw if there's economic profit, then in the long run, firms enter. So in the long run, firms would enter and it wouldn't be a monopoly and disrupt the monopoly, right? And so that's the real issue, is that even if they were able to surmount that initial problem, in monopolistically competitive industries, the barriers to entry and exit are relatively low. And so in the long run, new firms would enter. Number 3, we got to scroll over to see this one. Indicate whether the following statements are true or false and explain. Oh, I hate these. Like a firm in a perfectly competitive industry, a firm as monopolistically competitive industry is willing to sell out a good at any price that equals or exceeds marginal cost. So that's false, and we can actually see why. If we look at this one, right, this is a monopolistically competitive firm in the long run. And we can see that they're selling a price here at Q star. The price is not equal to the marginal cost, right? It's not. In fact, right, I've kind of said this before, the demand curve tells us the price. And so this point, right, that's the point where perfect competition would produce, where demand and supply equal each other. So we can say false, because, why don't we just say because marginal revenue does not equal the demand curve? Because if it did, right, if the marginal revenue was, instead of like this, it would be like whoop, like that together, then it wouldn't be a problem. But it's because marginal revenue and demand aren't the same. B, so this is why I hate these. You have to explain them, and it's like, I know that it's false. Suppose there's a monopolistically competitive industry in long-run equilibrium that possesses excess capacity. Okay. All the firms in the industry would be better off if they merged into a single firm and produced a single product. But the consumers would be made better off. But whether the consumers would be made better off by this is ambiguous. So if they possess excess capacity, which we know they do, like because they all do, like excess capacity means you're not producing an ATC. It would be better off if they merged into a single firm and produced a single product. I'm gonna say true. That one, because they could. This is kind of dumb. Because they would earn more profit. That's what I'm going to say on this one. This is why I don't like these kinds of questions. So more profit. I'm going to say that. And it's ambiguous whether the consumers are made better off, because in a monopoly, conceivably they could experience lower prices because they'd be producing it at a lower ATC, but we don't know that, and we don't know whether they would actually get the lower prices and they'd have less. I'm almost leaning false just because it's kind of a dumb question. Yeah, and I know the answers, and that's dumb. C, fads and fashions are more likely to arise in industries characterized by monopolistic competition or oligopoly, true, than characterized by perfect competition or monopoly. That is true. And that one's a fairly easy explanation, because they rely on advertising, rely on marketing. So like monopolists don't really have a need to market or advertise because there's only one product. Likewise, perfectly competitive firms don't advertise because all the products are identical. But marketing is what generally creates fads and fashions, and so we see that happen in these others. Let's take a look at the multiple choice questions. So I know you're not going to have a quiz on these, but it is helpful for thinking through how the book talks about questions. So number 1, which of the following is characteristic of monopolistic competition? They don't have a standardized product because they differentiate, right? You've got one restaurant selling Italian food, one restaurant selling Chinese food, and that kind of thing. Many sellers, that is true. They have many sellers. Let's look at the others. Barriers to entry. They don't really have barriers. They, some very limited. Positive long-run profits. No, they earn on zero economic profit. Perfectly elastic demand curve. Well, we can see it's downward sloping. It's not a horizontal line, so that's false. All right, let's take a look at number 2. Which of the following results is possible for a monopolistic competitor in the short run? In the short run, they could earn any of those things. They could earn positive profit, losses are normal, so E. In the short run, they can do any of them. In the long run, they earn normal. Which of the following results is possible? I predicted that question. That was good. So normal. They can only earn the normal because firms can enter and exit. So B. Boy, if only those true-false questions were like this. These are relatively straightforward. I say that though. Now which of the following describes a monopolistic competitor's demand curve? Downward sloping. B. All right, we're on a roll. We're like butter. Haha. The long run. It's bad when you laugh at your own jokes. The long run outcome in a monopolistically competitive industry results in, so inefficiency because firms are because they don't earn positive profits. Efficiency due to excess capacity. It's the opposite. They're inefficient because they have excess capacity. That's the idea that you're not at the minimum ATC. Inefficiency due to product diversity. Well, that's not why the inefficiency happens. So C is not correct. Efficiency because price exceeds marginal cost. No, that's the inefficiency. That's what we call allocative inefficiency. Remember, we've got allocative, which is price equals marginal cost, and we've got productive, which is you're at the minimum of the ATC. So D is wrong, so that leaves E, a trade-off between higher ATC and more product diversity. And that is true, right? We produce way up here at the higher ATC point, but we go like, yeah, it's okay because we get more stuff. We get Italian food and we get Chinese food, and sometimes we get sushi. Depends on, what time of year it is. Maybe, I don't know. Usually my wife and I like to go out for sushi for a birthday. So there's a couple of good little restaurants for that in St. Louis. Draw a correctly labeled graph for monopolistically competitive. Label the distance on the quantity axis that represent. Oh, we already did that, but we didn't label. So this is actually, I'm just going to go whoop, just like that. And the excess capacity range is going from like the Q star where we are to the minimum point right here of the ATC. So that's what we would call, I'm just going to say, that's the excess capacity. So it's basically the fact that we're producing at Q star and we have extra capacity in the firm where we could be producing more units, and every time we produce another unit, it'd be at a lower average shuttle cost, so we'd be more productively efficient, but we're not producing those units because we're profit maximizing, and so we call that excess capacity in the firm. And in fact, we do see that in a lot of monopolistically competitive firms. If you go to a grocery store, it's pretty unusual for them to use all of their registers all at once. If you go to any retail store, right, they usually have a ton of cashiers and fixed resources that they have, but they're not using them. And that's because at any given time, the demand for their internal products is somewhat lower than what their maximum capacity actually is. So that's kind of the idea of why they do that. There's your fun tie-in. All right, thanks for listening. See you next time.